Every time there is a stock market crash, you always hear the same line. No one could have seen it coming. But the truth is, the warning signs are almost always there. They just don't look obvious when everything's going up. And even though today's tech giants, companies like Nvidia, Apple, and Microsoft, are seen as stronger and more profitable than ever, hardly anyone talks about the fact that they all rely on one crucial link in the chain. A single company that, if disrupted, could shake not just the stock market, but the global economy. I'll come back to that later in the video. But first, it's worth remembering that whether it was 1929, 2000, or 2008, every crash has followed the same familiar pattern. So in this video, I want to walk you through what always happens before a market crash, how those same signs have appeared again and again, and whether we might be seeing some of those same patterns forming again today. Because once you understand the cycle, crashes start looking like what they really are: human nature on repeat. Okay, so if every crash is really just human behavior playing out again, the build-up always looks pretty similar, and it always starts with overconfidence. After years of rising markets, people start believing prices can only go up. Risk feels like something that happens to other people. Even the cautious investors start thinking maybe this time really is different. Then comes easy money. Interest rates fall, borrowing gets cheaper, and suddenly everyone's using debt. Investors, companies, homeowners, everyone. Credit flows everywhere, and people start mistaking access to money for actual wealth. Next, valuations start to stretch. People begin paying absurd prices for every pound of profit. Not because it makes sense, but because everyone else is doing it. The market stops reflecting reality and starts reflecting momentum. Then speculation takes hold. New revolutionary sectors, get-rich-quick stories, and everyone chasing whatever is rising fastest. Investing quietly turns into gambling. But no one calls it that because it's working for now. And finally, leverage. This is when people start borrowing to invest. And that's where things get dangerous, because when the tide turns, debt doesn't just magnify gains, it also magnifies pain. So when you mix all of that together, overconfidence, cheap credit, overvaluation, speculation, and leverage, you get the same dangerous mix that's fueled nearly every crash in history. It just wears a different label each time. And the thing is, when you look around today, some of those same ingredients are already back on the table. We've had years of rising markets, fueled by the cheap money of the 2010s, and even though rates are higher now, the mindset hasn't fully changed. Valuations are climbing again, optimism is back, and that same sense of maybe this time is different is starting to return. Now, just to be clear, I'm not saying the market's about to crash simply because some of these ingredients are back on the table. Markets can stay euphoric for years before anything actually happens. What I am saying is that these patterns have always been the early warning signs. They don't guarantee a crash, but they do tell you when risk is quietly building up beneath the surface. And what's interesting is we've seen this exact pattern before. Every major crash in history has followed the same rhythm, just with different players and headlines. Take 1929 for example. The booming 20s created a wave of optimism. Everyone was making money, and everyone thought they had investing all figured out. People borrowed huge sums to buy shares on margin, convinced they would pay it off easily once prices kept rising. But when prices started falling, that same leverage magnified the losses. What began as a small drop quickly wiped out entire portfolios. Fast forward to the dot-com bubble in the late 1990s, everyone wanted to own a piece of the new economy. Companies with no earnings, some with no actual business model, were valued in the billions simply because they had .com in their name. When reality kicked in, the Nasdaq fell almost 80%. And many of those future-defining companies quietly vanished. Then came 2008, the global financial crisis. Cheap credit, record leverage, and the property market that could never go down, right? Banks kept piling on more and more risk, convincing themselves it was all fine because, well, housing always goes up, right? And we all know how that ended. So why does this keep happening over and over again? Well, it's because markets aren't just about numbers. They're about emotion. When prices rise, optimism turns into confidence. Confidence turns into greed, and greed turns into overreach. People start thinking that they're smarter than the market. And it's the last part, the belief that it can't go wrong this time, that always sets up the fall. Markets don't crash when everyone's scared. They crash when everyone's convinced they're safe. So could it happen again today? Well, if you're being honest, some of the signs are definitely there, and most of the market's growth has come from a handful of mega cap tech firms like Apple, Microsoft, Amazon, and Nvidia. Now, to be fair, this isn't really a repeat of 1999. Back then, many of those dot-com companies were losing money. Today's tech giants are real businesses, profitable, global, and massively dominant. But here is where it gets interesting and very risky. Because even though these companies are huge, they're all standing on the same foundation: semiconductors. And there is one company at the center of it all: TSMC, or Taiwan Semiconductors, based in Taiwan. Nvidia, the biggest company in the S&P 500 today, doesn't actually make its own chips. Every one of its high-end AI processors is built by TSMC. Apple relies on them too, so do AMD, Qualcomm, and even Intel for certain products. The entire AI industry is essentially propped up by this one company that manufactures 80 to 90% of its chips in Taiwan. So think about it for a second. A massive portion of the global economy and trillions of dollars in market value depends on one company in one small region sitting right next to China. And here is the worrying part. China has repeatedly expressed its intention to assert control over Taiwan in various ways, both diplomatic and military. If that ever happened and China gained control of TSMC, it would throw the entire global tech and AI ecosystem into chaos. Now, you might be thinking, why not just move chip production elsewhere and eliminate the risk? Well, on paper, that sounds simple enough. And yes, the US and others are trying. TSMC is already building new facilities in Arizona. But here is the catch. The world's most advanced chip production is still overwhelmingly concentrated in Taiwan. These factories aren't like car plants you can just copy and paste. They rely on decades of expertise, deeply integrated supply chains, and engineering precision built over years. You can't simply replicate that overnight. In fact, experts warn that it could take close to a decade to build comparable capacity elsewhere. So if anything were to happen to Taiwan in the meantime, the global economy would still be dangerously exposed. And what about Samsung, you might wonder? Couldn't companies like Nvidia or Apple just switch to them? Well, in theory, yes. In practice, not really. Samsung's foundries still struggle to match TSMC's quality and consistency. Nvidia actually tried using Samsung's chips during the pandemic, but the results were so unreliable that they switched straight back to TSMC. Therefore, if something happened to TSMC, there isn't an immediate replacement anywhere in the world. And that's what makes this entire AI boom so fragile. So although we're told that today's tech giants are stronger and more profitable than the dot-com era, the truth is that the system is still built on a single point of failure. What looks like solid profitability today is resting on a foundation that's dangerously concentrated. Now, I'm not saying a crash is imminent, but it does show just how interconnected and fragile the system really is. But before we all start panicking, let's also be fair. Today isn't exactly like 1929, 2000, or 2008. For one thing, the financial system is stronger. Banks are more tightly regulated, hold higher capital reserves, and they face far more scrutiny than they did back then. And investors themselves are in a better position too. Most people aren't betting everything on a single company anymore. They're investing through global index funds that spread their money across thousands of businesses, sectors, and countries. That makes a huge difference. It means the average investor today is far more resilient than the speculator of the 1929, 2000 or 2008. So yes, the risks are real, but the safety nets are stronger too. So what should you actually do with all of this? Well, the short answer is don't panic, but don't get complacent either. You can't predict the next crash. Nobody can do that consistently. But thinking ahead is what keeps long-term investors in the game. If you're holding a global index fund, you already have a strong foundation. You own companies across the world, not just in one country or one sector. But if your portfolio is 100% stocks, ask yourself honestly, would I be able to sit tight if the market fell 30% tomorrow? If the answer is no, then it might make sense to add a bit of balance. Maybe some bonds or maybe some cash, not because you're trying to time the market, but because having that buffer helps you stay invested when others are losing their heads. Because historically, the investors who come out on top aren't the ones who predict the crash. They're the ones who keep buying through it. Now, the good news is that the core principles of long-term investing haven't changed. But what usually causes the biggest losses isn't the market, it's emotion. So if you want to build stronger investing discipline and avoid those same emotional traps, sign up to my free newsletter. You'll find the link in the description below. And in the meantime, check out this video to find out why Vanguard says you shouldn't go all in on stocks. See you there, and remember to stay hooked on investing.